Hi, welcome to the Industry Insight series from the JM Financial Center for Financial Research at IIM Udaipur. So today we have the pleasure of hosting Dr. Tirthankar Patnaik, Chief Economist at the National Stock Exchange of India. Dr. Patnaik is a seasoned expert in the Indian capital markets, bringing a unique blend of academic and industry experience. So welcome, Dr. Tirthankar. Let me begin by asking a question around one of the key capital market participants, the retail investors in India. In recent years, we have seen a surge in retail investors' participation in the capital markets generally, but specifically also in the equity markets. So, what structural or behavioral changes do you think this increased retail participation is driving in the overall market dynamics, liquidity, etc.?
So first of all, Dr. Momita, thank you for having me here. It's been a pleasure to be at IIM Udaipur at the center. So retail investors is something of a major feature that has happened in the Indian markets in the post-pandemic world. We've seen a significant number of new investors come to the markets. In terms of numbers, NSE started around 30 odd years back, 1994, and it took almost 14 years to get the first 1 crore investors in the markets. First crore took 14 years.
Oh my God.
And then the next crore took around 7 years. And the third crore took 3.5 years. You can see a classic geometric progression happening here.
Right. So that's very interesting.
But just before the pandemic, say FY19, we had roughly 2.7, 2.9 crore investors. And then things have picked up. And how fast? On September 20th, NSE's unique investor count reached 12 crores. So we've gone from 2.9 crores to 12 crores. And that's the pace that has picked up.
Right.
It took about 8 months to get the last crore of investors. Compare that with 14 years for the first crore and 8 months here. Right. So, in fact, the pace has slightly moderated in the last 6-7 months. Otherwise, in January of 2024, we had roughly 9 crores. January 24. By August, it had reached 10, and then 11, and now 12 crores. So about 6 to 8 months is what it's taking. And the investors are from several parts of the country, and almost all parts are covered. Today, and to ask you a question of why and how are these investors coming? So, there are various reasons. One, of course, is it's easier in terms of technology. India has had a policy-led initiative of digital public infrastructure, which we see it as Aadhaar, India Stack, and what have you, that allows identification very quickly. And this allows you to open bank accounts, to open any kind of demat accounts very quickly.
Right.
That's one part. The other side is with technology, access to technology. Today we are very young people, so India has very affordable data, very affordable handsets. Those things are possible. And thirdly, from a macro perspective, what has happened is that household savings from a real interest rate perspective have been also coming down in the last 6, 7, 10 years. So that kind of pushes households to go towards non-fixed income based assets, especially where markets give you, in the last 10 years, markets have been positive for 9 out of them. And so there was a case, and during the pandemic there were quiet periods, which also led to some slightly higher participation. And then there has been an entire ecosystem of easy access to the markets. So gamification of the what has happened in the US in terms of apps available on mobiles, which make market access very easy. All of these have sort of contributed towards markets doing well. Not just markets doing well, but retail investors coming in. They've seen wealth increase significantly. And yeah, so today retail investors are about 9.5% of the market, of a $5 trillion market. And this is just direct ownership. If you include indirect ownership, you add another 9%. So retail investment, it's a big number. How much? In dollar terms, it will be close to $1 trillion today.
Right.
And these are all factors that have come in to, create this phenomenon of rising investor VA. To be sure, other countries in the world have also seen it, but our scale is, of course, our scale.
Yeah. That's unbeatable at this stage.
We are big.
Correct. So Tirthankar, from a liquidity perspective also, again there have been views like, because some also see it increased volatility in the market with retail participation.
Yeah.
But from a liquidity perspective, the deepening of the market, the impact on this deepening, how do you see that, and what is your view on that?
So today, if I look at FY25 numbers, the average daily turnover was about 112,000 crores. So 1,12,000 crores was transacted daily in the cash markets. And today we have 11 crore sort of investors, but not all of them trade every day, obviously. So in FY25, we had roughly 3.7 crore people trade out of a 12 crore. 12 crore is what happened now, but FY25 number was around 11 crore.
Right.
So about one third of the investors traded, and that's when you're counting, even if you're trading once. Now, individual investors as a category, they are responsible for about a third of the market.
Okay.
So about 34% of this 1,12,000 crores is by individuals. Yeah. Now, to your question as to how their advent has affected liquidity, let me just go back 10 years, or no, just 5 years. So about 5 odd years back, the average daily turnover was about 32,000 crores. So if you come from 32,000 crores to about 112, that's the rise. But interestingly, the share of retail investors even then was 1/3.
Oh, is it?
So
okay.
What has happened is new investors have come in, of course, but the share of activity has remained the same. And let me go back 5 further years. So 10 years back, we used to trade roughly 12,000 crores. So 11, 12, 30, and now 3 times further. Even then, the share was 30.
Okay.
So I would say that investor activity has kept pace with the rise in market activity.
Right.
It's not leading to a rise in market activity. It's just kept pace because their share remains the same.
Right. Okay. That kind of also brings me to a next question. You've led me very nicely to the next question.
Please.
So, which is to do with how do we kind of sustain this momentum, but also deepen the momentum? Because if we are at 30%, what would be things on your wish list? Because you are there, you have a feel of what is going on. So if there are a few things that you think would be really imperative to deepen this further, let's say from 30 we want to move to 40, 50 kind of things.
So the first thing we would not want is investor share raising unnecessarily. Why would that happen? That's not an objective at all. The objective is wealth creation, frankly. When retail investors come to the markets, the idea is wealth creation, and it has been shown very well in literature that household participation in markets leads to an increase in wealth. All the way from Mankiw 1991 onwards, that there's a very clear evidence across that household participation in the markets leads to a higher wealth. Of course, there are various reasons why this happens, and there are also reasons as to why there are impediments. So it turns out that if you are from developed markets versus emerging markets, you have a greater proclivity to come into the markets. That's one. If you are educated, then you have a higher proclivity to come to the markets. If you already have assets, say a house, then you are much more likely to come to the markets versus not. So people try and solve their requirements first in terms of housing. Housing as an asset is in the literature. It's considered first. You build a house and then you think of a large equity portfolio. um, what we've seen in the last 10 odd years is that the retail share of the market has gone up from roughly 11% to 18% today, which is, as I said, $1 trillion. What that has done is that the size of the market, which is today roughly $5.2 trillion, 460 lakh crores, held by retail individuals, or individuals, I would say, not retail individuals, is about a fifth. And that has led to their wealth increasing significantly. In terms of numbers, Dr. Momita, today retail investors are about 85 lakh crores. 50 lakh crores out of this 85 lakh crores, 55 lakh crores has happened in the last 5 years. What has happened is, there are two things here. One, new investors have come in, of course. But alongside that, they have also seen a significant jump in their wealth invested in the markets, not activity. Earlier on, I spoke about activity. Activity has kept pace. But because the market has improved, market has increased, and NSE's market cap has, I think, tripled in the last 5 years. So significant jump has happened. So that has also seen wealth creation for individuals. The idea would be that this wealth creation sustains. That's the idea. When households are able to see capital allocated in assets that give sustained returns, and it's well proven, Rajan and Zingal is all stocks in the long run. Equities do give, we have the Mehra and Prescott equilibrium puzzle and all. So equities do provide much higher risk adjusted returns over time, and the idea is to stay put for longer and invest for longer. That's the idea. So when that will happen, there is more capital and there is higher wealth creation, and ultimately it contributes to the growth trajectory. So that would be an objective. And to how to do this in an ideal manner, in a risk adjusted manner, in a manner which takes care of the mistakes that retail investors might make, that's the important part. I can put one point here. You see, about 70-80% of all new investors today are less than 30 years of age. Now, most of them have not seen market downturns.
Exactly, that was what I was also kind of thinking, because once you have seen a downturn, then you know that always it's not going to be a upwards trajectory. And
so, markets have their upturns and downturns. It is important to understand. It is important to learn before putting in capital. And only then it leads to sustained wealth creation. So that would be something to aim for.
So speaking about this, the downturns and different cycles and the volatility of the market. So Tirthankar, do you also see things like mutual funds? The SIPs that we have seen increasing in the country. Are these also mechanisms to kind of build in this disciplining in retail investors to some sort?
Without a doubt.
Especially the 30-odd-year, oldies who have seen like only the market going up from the time they have entered. So, what in that area, do you think enough is being done? What else can we do as a message to
mutual funds in general, or ETFs are assets which are collective investment vehicles. And the idea is that if you have not done your homework enough to invest in the market directly, why don't you let the professionals manage it? That's fine. And frankly, in the last 20 odd years, mutual funds have increased significantly in the markets. The idea mutual fund sahi hai has been really helpful for the individuals. So much so that 20 odd years back, 25 odd years back when I came to the markets, debt mutual funds were much larger than equity mutual funds. Today, equity mutual funds are significant. It would be interesting to see, say 10 years back, a 20,000 crore number in a quarter. Today you get 28,000 crores in a month. So clearly, the earlier thought process of households moving their investments away from fixed income based assets, or not just away, looking at alternatives. That's one. And doing so in a seamless manner has helped.
Right.
So the mutual funds today, as I said, are about 9.5% of the market owned by individuals, equity mutual funds. And again, doing that in a responsible manner, a disciplined manner, is what the SIP is all about, and that's fine. I mean, a lot of work has gone towards people coming in and investing into the markets. So this is a general problem, frankly. In the literature, there is something called the SMP, the stock market participation problem. So on one side, we know that markets do provide higher risk-adjusted returns, and yet that does not mean that households will put capital all into the markets. There's a natural, there are barriers.
Correct.
And so in whichever way we are able to, surmount those barriers so that households invest in a responsible manner,
right,
either directly or indirectly through collective investment vehicles.
Right.
That's the idea.
Right. We've also seen a lot of investor education, initiatives taken at mutual funds, at the stock exchange levels, at the policymakers level. But at times it seems not cohesive. Everybody is doing, things. So any suggestions you have there where we can have a better platform? Because ultimately we want to educate these 30-year-olds who have been here for 4-5 years. We want to keep them in the market for the next 15, 20, 30 odd years till they retire. That's the idea, so that they hold on to their portfolio. So from the investor education side, do you have any suggestions that?
So it's like this, right? The market regulator SEBI has 3 major goals, as we generally understand them. The first, of course, is investor protection. The second is market regulation, and the third is market development. When you look at all these 3, investing, improvement in learning, financial learning is an integral part, and there's a lot of effort put in by the regulators, and in those efforts, market infrastructure institutions like exchanges, clearing corporations, depositories, AMFI, they all participate as well.
Right.
I can tell you that in FY25, NSE did no less than about 14,800 programs.
Oh, that's amazing. That's a big number.
Easily 20-25 per day.
Right.
And we touched about 800,000 investors.
Oh, that's a very encouraging number.
Us.
Right.
But when you look at 12 crore investors, you realize how much
more we need to be done.
So the sense is that people that have completed their education, people who are coming to the markets, they get touched by social media, and there's a strong campaign in terms of mutual fund sahi hai, or from NSE it is soch kar, samajh kar, invest kar. There's a very clear thought process there. And however, it's important that understanding about markets in general, understanding about personal finance, all of these need to be put in the curricula.
Exactly. So how do we catch them young?
We need to. Yeah. We have, I keep saying, we have 77% literacy in India, but financial literacy, some estimates say, is just at 27%.
Right.
So 73% lack financial literacy to an extent that would be considered desirable. And so, in all each one of our 1,200 universities, our 45,000 colleges, our 15 lakh schools, education about markets, education about personal finance in general needs to be provided. So it has to be done at a very young age. Students should be, should inculcate the habit of investing responsibly.
Right.
Only then, the SIP math works for you very well.
Correct, when you start that young.
Absolutely.
Absolutely.
So the returns that you get when you start at 30 versus the returns that you get when you start at 20. Significant difference.
Now that's a very interesting point, that we need to educate our younger ones to understand what is equity market, what is capital market, what is finances all about.
Yes.
And since we have such a large literacy level, why not kind of inculcate this at the very level of our maybe primary schools also, right?
True. I mean, this will also help them help protect them from things that would otherwise hear anyway.
Right.
So
right.
you might hear things which are not correct.
Right.
Why not provide them in your course curricula,
Right.
which
right.
tell you what is right.
Right. So interestingly, when I teach financial reporting and analysis, so I also show them a small video in which Peter Lynch does this experiment on primary school kids, and how they are able to make these portfolio decisions which are sometimes even better than some of the professionals out there.
Wow.
So if we can kind of inculcate such a portfolio design kind of courses or even workshops for them.
I would say start with regular investments that it makes sense. Take them to portfolios, take them to optimization. But the moment you catch them young, they reap the benefits of.
Especially in an asset like equity.
Absolutely.
Where compounding can give
really
you
make a difference.
Correct. Yeah. Even if you have average investment, but the compounding can do the magic for you.
You're right. You're absolutely right.
So even if you are just an index investors, so.
So the think about it. Nifty.
Right.
Nifty. It's been 30 years.
Right.
So Nifty's 30-year return is a 13% CAGR. Now, for a child to look at, even if he starts with 500 rupees.
Right.
And something that aggregates at 13% over 30 years, it's a very significant amount of money. Enough to meet life stage goals.
Correct. And retire early, which a lot of these kids actually...
If they would like to.
Why not? They aim to, have a good lifestyle, retire early.
Yes.
So,
in some sense, the Piketty world where your asset returns are higher than your G. The small r is higher than your G. Right. Students can. See, the 401k kind of thought process helped American households see a significant increase in their wealth. Right. So today, American households have some estimates about $51 trillion in terms of wealth. So a large part is also attributed to the support from the US equity markets here.
Correct.
I don't see why something like that should not be done for our households.
Right.
And that jump comes when you come early.
Right.
When you learn early, when you don't repeat mistakes.
And stick to it.
And stick to it, of course.
Yeah.
Long-term investment, certainly.
Yeah. So, one last question to kind of, overall wrap up our discussion, very interesting discussion. So, what do you see at a macro level, the general challenges and opportunities going forward for Indian capital market overall, and any ideas that you have that we should be careful about to meet these challenges as such?
So, what goes well for India? And I said, 30 years, Nifty has given 13% returns. The core idea is the Indian economy has grown at a 6.5% real growth for 30 years. That's the 30-year CAGR. So you have an asset which is doing rather well. And even if you might think, no, the rupee has depreciated, so it's not so great for a foreign investor, the Nifty return, Nifty 50 return in dollar terms is nearly 8%. So, this is an asset that works very well. Now for India at this point, despite all the geopolitical dynamics, geopolitical uncertainty, trade dynamics and what have you today, the Indian economy will still grow over 6% based on any of the consensus numbers or individual numbers. And over the next 5 years, 10 years kind of period, what's really going for us is our young population. So India is a country with 1.4 billion people with a median age of 28 versus say China, which has 1.4 billion people with a median age of 37. So our dependency ratios are far more favorable than any other country. There are, there is no country of the size of India with the kind of young people that India has.
Yeah.
Second argument, our per capita income is sub $3,000. So for us, acquiring for consumption is something that will happen versus say a Japan or a Germany or a UK where median ages are very high in the late 30s, early 40s, where per capita incomes are such that you don't necessarily buy more things. You may buy more experiences, that's fine, but you necessarily don't buy more things. So for India, in the next 10 years, it's the growth story of the world. If we don't mess up things, we have the growth story of the world. And that's, and I keep saying this, markets reflect the economy.
Right.
And that's the idea.
Right.
We can't give a direction to the markets.
Right.
But we may see what our economy can do with the kind of changes. So on one side, there is the population support. The other side is in terms of fiscal prudence, in terms of macro-prudential, steps that India has taken, fourth largest FX reserves, controlled current account deficit, fiscal deficit going down, debt GDP levels slated to go down. All of these make the Indian economy quite decent, and on reflection, the Indian markets. Now, what could go wrong? What could go wrong? So, on one side is, one clear side is climate risk. Significantly, we keep ignoring it, but doesn't go away.
Right.
And climate risk in the last few years has actually turned more from an academic, discussion to something very real. This is something to think about.
Correct.
Because you asked for the long term. We've also plans of an energy transition. Our Prime Minister has said that we need to go to net zero by 2070. Now, 2070 seems very far away, but it's not, in terms of the changes that a country like ours, which is the third largest polluter in the world today, needs to do. There's a lot happening there and needs there. India apparently needs about $10 trillion in investments to meet net zero targets. Before that, my other problem would be the quality of our labor force. So on one side, we can extol the virtues of a 640 million, 650 million working force, young people, but we should also know that our tertiary education, not just primary education. I earlier mentioned that our literacy is 77%. 77% is literacy when you write your name. How many people in India go to colleges? That number is 28. Tertiary education. In fact, our target is to take it to 50% by 2030. So we are there.
Right.
And how many of them complete college in an era where we're talking technology, we're talking,
so many distractions.
Exactly.
On the way.
How, and we've also understood the need for education, the need for learning. It's interesting that our labor force isn't educated enough.
Correct.
Now, India's size is enough that we have 50% of the world's global capability centers.
Right.
That's great.
Right.
But think of the rest of our population. So I would say educating our labor force to global standards, say tertiary education. How can we get a 70-80% tertiary education levels in India?
Right.
That would be a challenge and something that we should think about. So to me, these are some of the long-term sort of things that we should, consider about. Otherwise, there's a strong tailwind of the Indian market, Indian economy that helps the Indian markets.
I didn't have this question in my list, but because you mentioned climate risk, and I know that NSE is also coming up with a ESG rating division. So if you can spend just maybe a minute to explain, what is happening there, given now the BRSR framework, which has also come in, which makes us as a country, in terms of the disclosures respect to ESG, one of the most stringent, if you look at everything. I mean, some of the disclosures in India, any which way, is way ahead of, our, leave alone the developed counterparts, even the developing counterparts, Asia and everything. So with the advent of BRSR and, the local, I said ecosystem creation of these rating agencies, how do you see an impact on climate risk? Can we make the firms more conscious about these factors? Because to control climate risk, there's also some kind of qualitative, aspect that would come into picture. So what's your view?
It's a very fair point. So I think your judgment is right in terms of how we've gone about disclosures. I think it's bar none globally. I mean, there is the PRI, there's the TCFT, there are so many standards.
Right.
But India, we started out with NGRBC, and then eventually the BRR, and now the BRSR.
Yeah.
I think in terms of disclosures, that's the right thing to do. It provides investors a wider array of subjects, a wider array of data points on which to make their decisions. So that's on one side. That's on the the supply. On the demand side, we have the stewardship code. It is all well established in India. All regulators today insist that you should have all entities that have a fiduciary responsibility towards money, asset management companies and insurance companies and what have you, they all should have stewardship codes. So India has done well from that perspective in setting up a framework. And in addition to that, you said about ratings.
Correct.
India is probably one of the few countries that has, where you can't just give a sustainability rating. You have to have a license for it. You have to be eligible for it.
The code that came in from SEBI, that was very encouraging, that you need to be responsible for giving a rating out.
So from all three dimensions, from the company's perspective, following a disclosure-based regime, from the asset manager's perspective, having a stewardship kind of framework, and from the credit rating agency's perspective, not credit rating, the ESG rating perspective, you have to adhere to a particular framework as well. All these augur well, in my opinion, for a sustainability-led investment framework in India, general investment framework. There are a lot of things that are going right here. And the only thought process there will be to continue along these directions, and let the ecosystem now take root. Makes sense. There's a lot of right things that has been done, and just as we started with BRR for 50 companies, took it to 100, took it to 500,000, and at some point it was not necessary, then comply or explain, and then it became mandatory. Right. I think that gradual framework helps a lot.
Right.
It also makes it easy for the listed universe to absorb the requirements and then slowly come about, and at some point see the benefits that these disclosures accrue to the company.
Right.
Many of these companies, they raise capital abroad. Many of these companies raise capital or get investments from asset managers who are under stewardship rules. So if a company is able to differentiate itself in terms of providing better disclosure, cleaner disclosure, and then doing better on those metrics.
Right.
And not only am I, for instance, providing more information about your carbon emissions, but also telling how much of carbon capture I've done.
Also, a trend will be available now.
Absolutely.
I can go back and check what is happening, right? Which was not available before.
Which wasn't available earlier.
Right.
So I think we are in the right direction. In this case, the idea is to continue and keep up the good work.
Right. No, very interesting. Thank you so much. This is, we started from retail investors and we went to macro, and now, also addressing one major issue. You mentioned two very pertinent points. One is education, second climate risk. So closing with climate risk, and on a positive note that we as a country, we are doing well in terms of, trying to move towards managing the climate risk bit in
so
a good manner.
It is miles to go before I sleep.
Correct.
But I think we are on the right track.
Right. On that positive note, Tirthankar, this is such a pleasure to have a chance to talk to you and discuss these matters. And thank you so much for sharing your insights.
No, thank you. Thanks again. You're most welcome. It's my pleasure. Thank you.
Thank you.